What is your financial strategy? Is it to pay off your home loan, rent vest, or a combination of strategies? I want to take you through the pros and cons of each option. Starting with paying off your home loan. Now, the first pro of paying off your home loan is that it's a forced savings mechanism. Each month when you pay off your home loan, you're paying a portion of principal off that home loan, and you're effectively building your wealth each month. The primary residence also often has a capital gains tax exemption, which means when you later sell your primary residence, it's typically capital gains tax free. And that's an effective way of building your wealth as you upgrade the family home. When interest rates are high, like they currently are at sort of 6% for most people for their primary residence, it can be really effective to pay off your home loan as a priority. And the reason being is that if you compare that against, say, owning shares in your personal name, and if you're on the top tax bracket, you would have to earn around about 10% via those shares just to equal the net benefit of 6% by paying off your home loan, and that is a risk-free rate of return. Lenders also provide better interest rates when your loan to value ratio goes below a certain point. So typically below 80%, and lenders will provide a sharper interest rate, saving you money. So it can be effective to pay off your home loan quicker to get a lower loan to value ratio. In terms of the cons of this strategy, it is a simple and common strategy, but it may not optimize your wealth position, which I'll talk to a little bit later in scenario 3. When interest rates are low, so we can all remember back to COVID when interest rates were around about 2%, then you can see that by paying off your home loan, you're only benefiting by 2% each year. When you compare that to other alternatives, it could be a lower rate of return. Rent vesting. So this strategy involves you renting in an area where you want to live, but perhaps you can't afford, and then buying an investment property in an area that you can afford. So this is beneficial because obviously you can live where you want, you get the deductibility of the loan as it's an investment loan, and you can get into the market easier. However, the cons are that when you do sell this property down the line, typically there is capital gains tax, unlike with the primary residence. Strategy also heavily relies on the property having a really good capital growth rate. Now, I've seen many times in the past, clients have bought, say, off the plan apartments and they haven't grown for 10 years, and it's made this strategy really ineffective. Lastly, if you're paying interest only on this home loan, you need to make sure that you're still saving in your regular cash flow. Because remember, with the primary residence option, you do have that element of forced savings by paying the principal off each month. So if you're doing this strategy and you're not saving money, which can either go towards paying off the debt quicker or into other investments, then this strategy can really fall down as well. Strategy 3. So this is a combination where you might pay off some of the primary residence home loan, you might purchase another investment property and allocate surplus to that, have a family trust, put extra money into superannuation, buy personal investments, buy an investment bond, all these different types of things. Now, this strategy is good because it does allow diversification across different asset classes, and it can often be good for high income earners. Because as an example, high income earners can benefit from negative gearing strategies by using equity within their home to purchase investment properties, or by using family trust to be able to distribute income, or often they also benefit from superannuation more so as they save a higher percentage in tax by contributing. Again, high income earners as well, and people more broadly, can also use leverage, so by utilising their home equity to buy an investment property, providing it's a good property. And that's one of the cons here. You need to make sure that the assets that you purchase in this scenario where you're doing a whole range of things are actually really good assets, and they're maximising your after-tax returns. Again, tax issues. This is a big issue as well. So going back to this example, if you buy personally owned shares and you're in the top tax bracket, you'd be paying such a significant rate of tax that the net benefit may be no better than just paying off your primary residence. So for scenario 1, paying off your primary residence, for many people, this is the most common and simple and effective strategy, and that's fine. Where I find people get into trouble is in strategy 2 and 3. And I think that's where you really should see a financial planner, because you need to make sure that the assets that you purchase in these strategies are going to be ones that have a sufficient growth rate to actually get you moving forward, and your investments are in the right tax structure to be beneficial for you. So if you need help with your financial strategies, please reach out.